But that was justified in those cases because the founders had significant previous experience and actually had taken their other companies public. We're capital efficient, meaning we want to see businesses that can take off in under $1 billion. That almost always, not always, but almost always excludes like biotech and pharmaceuticals and in many cases hardware as well. And again, these slides are online, so you can download them and take a look. And then all of those things together, right? So we talked about startups and how they've changed. We've talked about how VC and how it's changed. What you're seeing now is that all of that's being reflected in the deals themselves. And again, the preface I'm going to state here is that remember that my perspective is more global. There's probably slightly different challenges here in India, but I'm intending to invest pretty heavily here. We'll see how it goes. But the point is, the first thing that's changing is that we're seeing standardized terms. By the way, we're also talking about early stage. Okay, so your first round, maybe your second round, stuff like that. We're seeing an increasing number of early stage standardized terms. So people are using like Series C documents or founders, what do they call it? I'm blanking here, but the founders, I'm sure you know what I'm talking about. I'll send the links out afterwards. But the point is standardized terms. Even with us, given our scale, we've pretty much moved to standard terms. And standard, by the way, I don't mean like, hey, everybody gets this valuation. What I mean is like, look, all the material terms are the same. Let's just tweak the numbers, right? It'll keep my legal fees down, it'll keep your legal fees down. We're seeing an increasing number of deals that have no fixed amounts and no closings. What I'm really saying underneath this, by the way, is I'm saying that a lot of these deals are turning into convertible notes. They're not equity anymore, right? So the thing is, there are no closing dates. If I give you an okay, I just wire you the money and sign the paperwork, I don't really care if that investor's ready to go. I'm ready, right? That's very different than an equity round where you're trying to like herd a bunch of cats together and get them to do the closing. There's no leads, right? There's no leads at all. They're continuous, not discrete rounds. What that means is you're not saying, hey, I'm going to raise this much money and that's it. What you're finding is that if you can create a market, it could be continuous fundraising. You could actually close a little bit of money and then open up a new round immediately afterwards. In fact, one of the pieces of advice I give my companies is, let's say you have a number in mind to fundraise, right? Let's say you want to raise $750,000. I wouldn't go out to the market and say, hey, I'm raising $750,000, give me some money. Because the inertia that is required is very tough. In fact, what I would suggest you do, and be careful, this is just my advice, ask all your other friends to validate it, but I would say break your round up into the 1/3 and the 2/3. You start by saying, I'm going to raise $250K, and you close it fast. You get to the magical oversubscribed word. That's the O word, it's so magical. Once you say that word, like magic starts happening, it's fantastic. And you use that to then springboard into the larger 500 round. Now it's up to you if you want to raise valuations or not. That's more nuanced. But the point is, though, is that the rounds are continuous. And the example I just gave you, the advice I just gave you, is an example of a continuous round. Prices are beginning to float, right? It used to be that everybody in that round would get the same price, the same terms. But if you seriously think about the advice I just gave you, then what you'll actually understand is if you pull off that first $250K right, that by the time you get to the first dollar in the new round, theoretically, you should have a lot of people super excited. And basic supply and demand does allow you to raise that price if you want to, right? Anybody? I can't see, it's so dark, I can't even tell if you guys care. Is this good? Is this useful? Yes. All right. I hope you're not just stroking my ego, but even if you are, I like it, so it's cool. So the other thing is no board seats. No board seats at the earliest stage. Now again, I'm not suggesting that investors shouldn't be providing governance, right? Because that's the point of the board. But what I am suggesting is that if you have only raised less than $1 million and you're still kind of feeling out product market fit and you're just now testing customer acquisition channels, what good is a board going to do for you? And I know probably all the founders are like nodding yes and all the investors are saying no, but like this is happening and you don't have to take my word for it. It's not just happening in our portfolio, it's happening everywhere. Y Combinator, Techstars, everywhere. So it is a reality now. And then finally, I think one of the things that we as investors hate to admit, that herd mentality exists. We hate to admit it, right? Because, like, just try this. Like, put a beer in these investors later on tonight, because hopefully they'll be coming out, including me. And then you say, like, well, Paul, do you follow other people? And they'll just like, no. We make our own decisions. Like, we're very, we love founders. They'll say the same thing. And sometimes I say the same thing too. But the point is, though, is that herd mentality exists. This means that founders, you shouldn't go hit the entire market and say, hey, we're raising money, look at me, look at me. What you should do is be very strategic about who you're going after. Right? So when you open your round, you don't open it to the world. You go after the 5 or 6 investors that are so useful to you and you think are so likely to invest that you get them on board and then you use their name to get to the next level. Does that make sense? So, and that's the summary at the end there, is that the herd mentality, you can use that to your advantage. And I mentioned oversubscriptions before. If you play this whole scenario out in your head, you can actually move the market forward. In fact, I'll just say as an aside, if you're not sure what to pitch about when you're talking to an investor, you only need to say fundamentally 2 things. You need to understand there's only 2 things that make me write a check faster than anybody else. It's fear of missing out, right? And it's greed. That's it. Don't tell me that you want to change the world. I'd like to change the world too, but I have a fiduciary duty to make money. So, fear of missing out and greed. You change the world, that'd be great. I would love for me and you to make a lot of money at the intersection of social good. Love it. But let's focus on the greed first. So this is actually one of my favorite quotes. And it is, do I need to read that to you? You guys can read, right? So while you're reading, I'll just say that this is a statement by Michael Lewis. It was in the book Moneyball. And the reason I show it is because actually, if you think about the underlying thing that I'm talking about how the markets have changed, what I'm really talking about is transparency. Right? There's been this increasing amount of transparency. It also makes it harder for you to raise money because now I know more about your industry than it used to be. It used to be if you were the one founder pitching to me, I probably only had enough insight into what you were doing and maybe what 3 other startups in your space were doing. But today I can Google it. Today I can go on AngelList and click on the category you're in and see who else is raising money. Right? So transparency, like most things, is a double-edged sword. But anyway, net, I think it's good. It's good unless you were trying to be a big fish in a small pond, or unless you were trying to like screw someone over. So in terms of transparency, here's some examples of stuff, right? So, and now that I've posted this, you guys have no excuse to have shitty pitches. So if you want to see what actual demo day videos look like of companies that get funded, like with real serious money, like no joke, then what you should do is go watch the live stream videos. Those videos we put online. We don't invest in stealth companies. Everything's available. Right? So if you go on there, it's so easy, you don't even have to be lazy. It's 3-minute pitches. That's all we really allow. And you'll get to see what's happening. You'll also get to see their slides, but if you want to download their slides, you can go to SlideShare. Right? You can grab that. If you want to learn about venture capital, you can go to venturehacks.com. All these other investors are writing about this stuff online. The point is, the power is shifting to you, founders. Like, that's the idea I want you to understand here, is that power is shifting to you. And it's only if you keep eating up all this information. Does that make sense? Can you be a little louder? I can't even see you wherever you are. Yeah?
All demo day videos are stored online on this site?
Yes, all demo day videos are online. It's a little bit tricky, to be honest. Like, we haven't done a very good job of like filtering it all out and whatever else. But actually, if you go to that channel, the 500 Startups channel, we've got all of our videos on there. Just dig through it. You'll see like demo day July, demo day January, demo day August. You'll see them all. I mean, that will give you at least 100 videos to watch. That's probably at least 400 or 500 minutes of content if you want to watch. And we invest in all sorts of verticals. So like, doesn't matter where your startup's coming from or what vertical you're in. There's probably some startups that are similar to yours. And again, you can download this if you have any questions. And by the way, if you don't understand what I was saying earlier about like convertible notes, equity, closings, all that stuff, that's okay. Just go to the Venture Hacks website and go to the archives. That was actually written by Naval, the founder of Ingos, Naval and Nibby. And it's a very, very good resource. They actually have it broken down into the different sections, like term sheets and equity and stock options and everything. Everything you pretty much need to know is on there. And these other 4 investors are very, very prolific in the US and elsewhere. So your key takeaways, right? And I'm particularly talking to the founders about what I think you should do if you want to raise more money. And then I'm going to say the same things to the investors though, but the angle they're looking at it from is I'm trying to tell them this is what you should be looking for. So the first thing is you need to focus on traction. And I know everybody knows that, right? But for some reason, like most founders, not only in India, everywhere, most founders in there just don't pay attention to that. And even if they do have traction, they often bury it. So my takeaways for you are, focus on traction and learn to communicate and inspire. What I really hope happens here is that your pitches will change. So I want you to start with traction. You know, Pankaj and I have seen lots of deals now in India. And the vast majority, if not all of them, even the ones with traction, it's not even clear they have traction until 5 minutes into it. And that's a shame because like you're at the mercy of me not losing my attention span. And like anybody that's spent like 30 seconds with me knows that I'm like squirrels are better than me, right? So you need to start with the traction. But I hope you learn. And the thing is like when you watch those videos and you read those websites and stuff, what you really will be paying attention to is when you're first learning this stuff, you're going to be paying a lot of attention to the slides and the words and all that stuff. But as you kind of figure that out, the next thing you'll spend a lot of time on naturally is just how you deliver. So like, here's one of my observations of the Indian founder, right? The Indian founder, like if you tell them, and I'm not trying to give you shit, I invest everywhere so I just see all this stuff. The thing is like, if you tell an Indian founder, if you say, hey, so for example, there's pitches today, by the way. If I were to say to those founders, hey, instead of 8 minutes, you have 4, what would they do? What do you think they would do? Not a trick question. What would they do? Yeah, they would talk faster, right? It'd be like fucking micro machines, like super fast. It'd be like chipmunks. But that doesn't help anybody. It doesn't help anybody. I think you guys need to be more, you as a society, need to be just a little bit more, like pick your words a little bit more carefully. There's no need. I personally think there's an inverse relationship to how much you say and how successful you're going to be. Think about it. Like, I don't want to throw anybody under the bus, but think about some of the pitches you heard this morning. Sorry, guys, by the way. I'll buy you a beer afterwards. Maybe, actually. Maybe it's a cheap place, maybe. But, so, I'm serious. I don't have a Bentley. So, the thing is, think about some of those pitches today. Didn't they start out a little technical? There was like one guy who's, God love him, he was great startup. I don't remember the name, of course, but he started out with like, it was this thing for developers, and he just went like straight into this like total technical jargon thing, and I just almost died in the back. And then I made it to the door really fucking fast. And I faked that I was on the phone, so I didn't look disrespectful. By the way, you know the trick to actually looking like you're busy? The trick to like looking like you're busy is just to walk quickly from a corner of a room to another one. Because then people are like, oh fuck, that guy's busy. Try this. And actually, in all seriousness, for startups, the #1 mistake you can make when I send you an email, don't do this to me, do it to other investors, by the way. I'm serious, don't do this to me, do it to everybody else. But the thing is, like, when I say, like, hey, are you free on Thursday, right? Don't reply back and say, anytime Thursday. Again, don't do this to me. But, like, the point is, because what does that imply? Right. Yeah, and you know what? This problem is even tougher in India. In America, like, even if you are free all day, it's fine, because it takes 15 minutes to get somewhere, it's fine. But in India, you lose half your day and go like fucking 1 kilometer. It kills me. So the point is like, give people like 2 or 3 times. Don't be a dick about it, but just don't come across as like bending over for the investor. That's not what anybody wants. So again, my name is Paul Singh. We're investing heavily in India. You'll see a lot more of me around, but don't pitch me, pitch Pankaj. He's the one that lives here. These slides are online on Twitter. I'm available on email there. My blog's there. I'm really, really optimistic about India, and that's why I've spent so much time here. That's why I heard, I'm not allowed to say, but I heard that we might be raising a fund here. But like, we are really, really optimistic. And all I really need you guys to do is build incredible businesses, and I've got unlimited money for shit that works. So thank you. Yeah? Okay.